Good morning, ladies and gentlemen. The risk dial is still showing the wrong numbers. It's around -10. I compute it by hand. So we're in negative territory and still in risk off in all time frames. Unfortunately, we're going to have to rewrite all the Python script, and that's going to take a while, and then update the site. Hopefully it's not going to take much more than another month, and then we can have a huge addition to all the stocks that we follow and all the ETFs. But until we've done that, in these weekly videos, I will update it by hand and tell you what the score is. So around the -10 area and still very much in risk off. Why is that the case? Well, that is the case because stocks and bonds are very much tied together at the moment. And let's examine what bonds are saying in order to understand where stocks should be trading. Why are stocks and bonds tied together? Well, this is, I think, the only chart that matters at the moment, and that is the relative yield of the two assets. While stocks are yielding so much more than the 10-year or the 30-year, if you want to use that, it just means that stocks cannot deviate far away from the yield. Everything in investing is relative. Where can you get more yield? And at the moment you can get more yield in stocks than you can get in treasuries, and therefore this relationship cannot change very much. The only reason why this relationship would change very much is if we had a recession in the United States and the market started anticipating that, and then this differential could widen somewhat in a big risk-off move. Are we getting risk-off at the moment? No, we're just getting the relative interplay between these two assets. Until and unless the 10-year note starts going up in yield considerably, stocks are going to be supported at whatever level, and naturally we'll examine those levels later. But this is the only chart that matters to me at the moment. Where can I get more for my money? So this week we had the FOMC, next week we have the ECB. Now, what is so important about the ECB next week? And that is because QE leaks. Just because the Fed stops doing QE does not mean that worldwide QE is over. While the Bank of Japan and especially the ECB are doing massive QEs, that will leak via the foreign exchange market into USDs. And as I've just told you, the USDs are going to determine where equities trade. So while that is going on, there is no reason to expect a huge fall in equities. But let's examine what bonds are saying, and this is the 2-year note, and this is the move that we got when Powell started speaking. I've been saying to you for a long time that I think 2s, 10s are going to trade into the 50s, and that's where we are. 2s belong here around 1.5%, and that is where we're going. I think it's really as simple as that. Over time, the market is going to start discounting 4 or 5 hikes this year, and maybe 3 or 4 next year. And we will be quite soon around this 150 area for the 2s. Here we have the 2s, 10s, and as I've been saying for a long time, that belongs somewhere around here in the 50s, and that is where we're going. First line of support is here around the 55 area, 54, and then we are going to be into the, below the 50s, into the 40s. I would have thought that it's going to be quite comfortable trading here for a long time. Look how long it traded here back in March to July of last year, that kind of behavior would really not shock me, not surprise me in the slightest. Basically anything between 40 and 50 for a long time. We're getting to the end stage of that move. And what does that mean? That means that the front end will have done all that it's going to do, and it's going to be basically await the Fed moves, and everything else is going to be, instead of the short end wagging the tail, after that it'll be the long end that wags the tail. The rest of the yield curve continues to flatten, 530s on a weekly. What a great level that was. Anyway, I don't really think that we can flatten that much more, although the flattening tendency is evident. A flattening curve basically means that the market is fearful of recession, a Fed-induced recession, a Fed mistake. I think it's far too early for that. I think we've probably gone too far, but that's neither here nor there. It's just relentless in whatever tenure you look at. This is the 10s, 30s, and that is at 30 basis points. That is about as as flat as you are likely to see it for quite a long time. This kind of level, 24, looks ideal. In fact, I'll put in a little reminder there for myself at around this kind of 24 level that I probably want to start fighting it. It's unlikely to go straight through it without data. I know that the market needs duration. People are buying duration. But what we do have is a huge amount of issuance this year, starting later on this quarter. And with the Fed stopping QE in March, we are unlikely to see much better yields, i.e. lower yields, than we are at the moment. So, unless data starts being extremely negative, unless PMIs go negative and the market starts discounting less Fed hikes, but in any case, less Fed hikes would steepen the curve. And therefore, I think that starting to fight 10s, 30s around 24 and starting to fight 5s, 30s somewhere around this 40 area or even 38 is not the worst trade in the world. What are 5s saying? Basically, 5s are behaving much as they did here. They will now trade up towards 177, 178 and back. It's really not, to me, that material where we trade. I just want you to see how big an area this was, how important. We basically spent 3 months, a whole quarter, trying to break above 178 and failed. While we're doing that, I don't think there's a big problem with 5s unless we start going through 178, but I think we will definitely trade it. I'm definitely a buyer, on every pullback down towards 155. I think the risk reward is overwhelming that we trade 178 from levels like 155. If you have a look at here, 154, 155, this kind of area, definitely risk reward is all towards 178, unless data starts turning negative. But I just can't see it. I really can't see that that inflation or employment, which are the two things that the Fed really looks at, are going to show you any kind of reprieve in the short term. This is a weekly and a daily chart of the 10-year note, and it's basically trading very well within ranges. You can see that at some stage, I'm a betting man, and therefore I'll bet that we will trade 203 at some stage in the 10s, but that will be a top for, 30, 40 basis points on the downside again. Exactly what the daily chart is saying. Every time it dips towards 169, you buy it, and then around the 185 area, that is the top. At some stage it'll break in and go towards 203, and that should be about it. I really don't think the problem is in the long end. I think the problem is, getting much less of a problem in the short end, because the yield curve is getting towards that 50 area, 2s10s, that I keep on saying is going to be important. So if you say that 2s are around 1.5, that gives you 2% in 10s. So that is, and that gives you a yield curve of around 50 basis points. I think that over time is what we will see. If we switch the view to 30s, you can see how also that is not a problem. This is a daily chart of the 30-year yield. We've been basically stuck around 210 for 2 weeks. Up, down 10 basis points, and that's about it. I think that will also trade 224 at some stage, just like, we have very good support in TLT around the 141, 142 area. A little bit better than worse. It's really as simple as that. It's a trading market at the moment. QE is leaking and will continue to leak. Don't forget that Fed is still doing QE till March. Okay, so really very little that you can hope for till March. I know that the markets anticipate, but there is still huge QE going on from the US and from the ECB and from Japan, and QE leaks. Therefore, really for the market to start doing much worse than 224, i.e. it has to start anticipating that the Fed QE is going to be over, probably a little bit too early, and it has to start anticipating huge supply, which we will get, but it also has to start anticipating having some kind of an idea when the ECB QE, and that one is the most important, will be over. And that we might find out in the next months, but probably will not find that out on this Thursday. But, there could be some hints about when that will be over. And that will be the spur for the next leg higher in yields. I keep on telling you that this chart is very important, the differential between 10-year US and 10-year Germany. And it's basically stuck at 182, isn't it? I mean, it just a magnet. It tries to break higher, it can't, it comes back. It's basically stuck at 182. Now, what does that mean? It means that people find, it proves that QE leaks. But B, it proves that people find value at that level, swapping out of German bonds and into US treasuries, and that dampens any move in US treasuries. While that continues, and I am not a mind reader, I have absolutely no idea what the ECB is going to do this Thursday, but knowing how dovish they are, and knowing that there are some internal dissensions, at some stage, at one of these meetings, we will get some kind of a hint. And when the market gets that hint, you will get a substantial move lower in this spread. What kind of a hint could it be? I have absolutely no idea. But some kind of a softening in the stance of absolutely no rate hikes ever. All the market needs is some kind of a tiny hint that they are turning less dovish. And that will really set the cat amongst the pigeons. Especially in my favorite thing here, the Schatz. The Schatz is basically stuck between, this kind of level and the top. So basically in terms of futures, 15 to 90. This is 15 to 90. And, you know, could this be an ABC that comes back down to here to around 2022? Yeah, sure, it could be. But to me, the risk reward is all on the upside. If you're risking 15, 20 ticks to make 50 to 70, and I will show you why the 50 to 70 plus. Because when we start breaking these levels, we have basically nothing until 45 minus 45. And then if I switch this view to weekly and change it, you will see how much of a catch-up we have. We could go all the way, damn charts, I apologize for this. Here it is. We could go all the way to 0. Okay, so, and don't forget, if you compare this chart to what the 2-year note was doing, it's very much similar. And let me see if I can actually go back to here. Here it is. This is the 2-year note. And look at this period. Look at this period. Look at this period. And when it started breaking, it just went berserk. Now, if we return to the 2s here, this is, you know, you can see how long this has been. This has been basically since 2016, okay, middle of 2016, and so that is 5 years. When we break this 5-year, you know, top, this is going to go 50 basis points in no time at all. Do I think it's going to happen this Thursday? No, but that is the risk reward, and the risk reward is absolutely massive. Not much point really showing you the bobble and the bunds. They're stuck. There is no change in the levels. You know, the risk reward in those on any move down to minus 49, minus 50 in the bobble, you know, an ABC kind of thing, retracement is going to be overwhelming, just like in the Schatz. The yield curve in Germany steepens when things go badly, as it were. It basically wants to catch up with US bonds, but it can't because the ECB is basically holding the short-term rates where it's held them for years, i.e. The same targets around minus 70, and that makes the yield curve in Germany steepen, while it makes the yield curve in the US flatten. QE is leaking out of Europe into the US, and that is holding US rates. And I keep on saying to you, and please be very aware of this, the day that the ECB hints that they are going to slow down or in any way reduce the amount of QE or allow rates to rise is the day that all the markets, all the bond markets get slaughtered. Because if the market starts anticipating that that leakage out of Europe is going to stop, you get a huge dollar move the other way. You get a dollar weakening, but B, you will remove the crutch of support in the US markets as well. So it'll be a sell everything. It'll be a sell bunds, Schatz most of all, but it'll be a sell everything because that crutch of support will have been removed. And as I've been saying, the US dollar up. What is the target? 98.54. Over the course of the next couple of weeks, especially if the ECB does not change or give any kind of hint that it's changing its policy, that will be the path of it, simply because the QE leaks. So, and the transmission mechanism for the leakage is the US dollar. People swap out of euros into USDs, and that puts pressure on the dollar. Can the ECB continue being silly and not allowing their rates to rise in the slightest, or not reducing their QE? Well, yes, they can for a while, but all that is going to do is actually make the US dollar more and more attractive. There is absolutely no point in fighting this. If I change this to a daily view, you will see that really, we'll probably have a couple of days of consolidation, but then we are really looking towards this 98.50 area, and then possibly up to 99.77 par. It's a trend. We are in trend. Anything above 95.07, any kind of a dip down towards that area, which I don't think you will see much, takes us up to the 98s and then to the pars. A period of a stronger dollar. In terms of Euro USD, and this is a weekly chart, I think there is absolutely no doubt that at some stage we trade 109.92. You can see the amount of weekly closes and weekly support and resistance that we've had at that level. And I, absolutely no doubt that will be traded at some stage over the course of the next couple of weeks. If the if the ECB is, stays rather as dovish as it is, I have very little doubt that within a couple of weeks that, just below 110 is the level we trade. Well, with a stronger dollar, you get a weaker gold price. Bonds are doing nothing. Up and down, and therefore, they're not doing any, they're not really helping gold, and the dollar is harming it. So we get a little down move. On a weekly basis, you can basically see that we are stuck in a range. I mean, how much up, down within around the same price can you do? If you have a look at the dailies, yes, we try to go monthly up. We tried to trade 118.81 again, failed badly because of the last, because of the US dollar. And now, 1764 and below 1764, there's really nothing till about 1710 in terms of support, and then the really big support is 1658. Gold is holding up relatively well, but that is because of DBC. And if we have a look at DBC, this is, how many high closes? 1, 2, 3, 4, 5, 6 weekly higher closes. But I suspect also that this is the last move up. If you say this first wave, second wave, third wave, and a complex fifth or something like that, who cares? But basically this 2430 area is unlikely to be surpassed without a lot of sideways trading. And if you do a kind of projection, you will have the 100% here around 23.23. And really, once you get there, which is only another, 3% or so, you are beginning to be on fumes in DBC as well. Okay, so I really would not want to be very long above 23.23. I think that is basically where you start being on fumes. And that will actually get us to this kind of area, 638 in deep gold over DBC. I think once we get there, gold will probably be a much better buy. You abandon DBC and you transfer that portion of your allocation to gold. That is what I've been saying for a long time, and I see absolutely no reason to change my mind. and that is because oil is still strong. But I think when we get to this area, was that 92 up to 99, 92 to 99, I think is going to be very difficult for the gold price to sustain. And that actually gets us to DBC around that 23, 24 area. And I think that's probably about it. That's my baseline case, and I'm sticking to it. DBC much better than gold still, but we're getting to levels where DBC is going to be on, on fumes, because CL is going to be on fumes, and that is probably a good area to get out of DBC, CL, and swap that part of the allocation for gold. Well, equities. And now you can see why equities can't really go down until these blue angels start turning over. I'm not saying they won't. I'm just saying that until they do, it's unlikely. You saw the earnings for Apple, you saw them for Microsoft, they're strong, still projected upwards. Well, these kind of levels are really unsustainable until and unless bonds start to really, really ramp up in yield. I showed you the chart earlier of the relationship between bonds and this one here. While this kind of gap exists, people are going to prefer equities, and until and unless this yield really ramps up, that relationship isn't going to change. Okay, so that to me seems obvious. I really can't see this chart dropping out down to times 18 unless the market expects a recession in the States. But then you will have those forward earnings coming down, right? And they're still going up. And therefore that means that trading around that times 20 is where the market is going to be, while we have this battle between the bulls and bears, between risk on and risk off. You will continue to have this magnet to times 20. Now the battle between the bulls and the bears will only be resolved when we have some fundamental data in. Between then and now, all we have is speculation about the US consumer. Is it screwed because of high inflation? There's probably a lot to it. I think the US consumer is going to be very challenged this year, and you've seen that in the price of Amazon. The only tech stock really which has cracked, or FANG stock, is Amazon, and that is because, and the weakest sector is XLY, Y being the discretionary part of the consumer. This inflation of 5, 6, 7%, whatever it turns out to have been over this period, is going to knock unless wages catch up by that amount, is going to knock the US consumer sideways. And going forward, we'll have much slower GDP. Does that mean a recession? No, it doesn't. There's so many variables here. There's so much to fight over that fight is going to take some time. And while that is happening, this 45.35 level, which is times 20, is going to keep on being a magnet. Okay, we might even go slightly above it depending on what the bond yields are doing. But while bond yields are doing not very much, going up and down 5, 10, 15 basis points and back again, it's unreasonable to expect that 45.35 won't trade again. And it's unreasonable to expect that it won't trade many times until and unless these blue angels start rolling over. And just to underscore how important that relationship between bonds and the US equities is, this is the equity duration of US stocks. The higher the duration, the higher the match you would expect to bond yields and the sensitivity to bond yields. And here we are. And this is the explanation why US rates at the moment are more volatile than certainly European rates. European equities, because European rates are doing relatively little. And you will expect that this number will jump up to meet the US only when the ECB does something, and does something pretty dramatic. I mean, it won't be this number that jumps up, but the relationship between US stocks and European stocks will get closer. At the moment, you will have noticed the European stocks are much less volatile than US stocks. And that is the reason, because US stocks are much more duration sensitive. And while this battle goes on between bond yields, it is absolutely normal that US stocks should be more volatile than European stocks. So at the moment, watching what European stocks do is probably not going to be all that beneficial to giving you a clue as to the bigger picture in US stocks. There is, of course, a relationship, but you will see why this relationship is lessened is because the duration of US stocks is so much higher than the duration of European and Japanese stocks. And while that is happening, you will see, you now understand why the US is so attached to what bond yields do. Okay, so SPX. Well, you saw the 42.47 to 43.12 area, this very important knot of support that I thought was last week would be so important. Well, yes, it was. And we bounced straight up. I mean, do I think that Friday was very significant? We're getting the earnings out of the way and the blackout period for buybacks. So, of course, the market was slightly weaker. Where does the market go? I mean, to me, the really important part is 42.35. Can we trade slightly higher than 42.35? Yeah, we could, but I don't think that's significant. The significant part is that we will be coming back to 42.35. And I showed you the Blue Angels, and I showed you the reason, and I think it's unreasonable to expect that over the next 3-4 weeks, unless and until the ECB changes its policy because of the QE transmission from Europe, from Japan into the US, bond yields go nowhere at the long end. The short end is catching up. The yield curve is getting to levels which are probably as flat as it's going to get until we get some real data, and that is going to take some time. And that to me means that 42.35 keeps on trading until we get a resolution. Going down into the shorter time frames, this is now 195 minutes. You can see that, this 200 period moving average is flattening and cooling. Over the next couple of days, it'll probably be down 45.50 or something like that. It's not going to move very fast. I'm just showing you why the market is basically, I really don't think that we can go below this area for quite some time. I think what would be reasonable is this, and we can actually try to see together what happens. The low, the high, the low. What are we looking for? Well, we are looking for a move to around here between 4,600 and just below 45.35. Is that unreasonable? Absolutely not. Will it mean that we have bottomed? No, it won't mean that at all. This could be just A, B, C, back down. But what I'm trying to get to you is, I'm trying to explain to you the thinking and the rationale behind these levels. The rationale, very simply, is that while the blue angels are still pointing upwards, and the bond yields are doing nothing, it is completely unreasonable, illogical, idiotic to expect the market to start breaking down from below this very, very important support level, which matches on the blue angels, and go back and have a look at it, the levels that we are unlikely to break. We're unlikely to go to times 18 unless and until A, the forward earnings, expectations of the forward earnings start rolling over, or B, the yields of the bonds make us do that. Extremely unlikely. I would bet you that we will see these levels, 45.35 to 4600, well before we see a break of 42.32. I think that is far more likely than that. And looking at the most duration sensitive sector, here we are. We basically came back to the 50% retracement of this move and bounced straight off it on the weeklies. What is likely to happen now? Well, I think Apple earnings probably accounted for a good part of the bounce on Friday. Well, let's have a look. Technically speaking, what we are likely to get is some kind of an ABC retracement here as well. And we basically go like that. Sorry, this high was here, wasn't it? And here we are. And what are we likely to get? Well, we're likely to get a move, at a guess, to around 14,900s to probably 15,200, which is exactly the level that it really broke down from, right? This kind of level. And where did it break down from in SPX? What was the scene of the crime? 45.35. It all points to the same kind of thing. Here we have the 200 period moving average also turning over. And this kind of a bounce is probably going to be all we get, all she wrote in NQ, but a bounce nonetheless. And really, I find it very difficult to understand why people want to get that bared up at levels which don't make fundamental sense. It just means that they are not thinking fundamentally. But there you go. Fundamentally, I see absolutely no reason to be bearish at these levels. And don't forget that this was actually, the exact point you should have turned bullish. 13,717, 1.618, projection of the move down. So anywhere in this area. And I keep on trying to buy it for a day trade. On Friday it worked. I think that we will see the 15,000, whether it's 14,900 or 15,200, I don't think that particularly matters. All that matters is that these levels will keep on trading while this battle goes on, because bond yields are unresolved. The only proviso I would put to that is Thursday, if and when the ECB hints that it's changing its policies, it'll be a very, very bad day for bonds worldwide, and it'll be a very, very bad day for equities worldwide. The VIX has also given a little bit of a buy signal for SPX. On stuff that I use. Basically, it couldn't close above 31 on Friday. It closed pretty much on the lows of the week. And that to me says that we trade this 2251 area again, and probably even, down to here, 2113, whatever it is, it's unimportant. The exact level is unimportant, but basically what it's saying is it trades this level again. And that to me is confirmation of 45.35 written all over the market. Really as simple as that. If you look at the patterns here, that is also very interesting. It's a repeat. Every time it spikes and then it comes down, it trades down 2, 3, 4 days on the trot and then spikes up again, or even 2 weeks and then spikes up. So there are definite periods that it's, whether it's 4 or 5 days and then another spike. And that also gives you the timing that there will be no spike until the end of this week. Now, we all know what the end of this week is, and that is Thursday, and that is ECB and other data. Well, the ECB to me is the most important. So don't expect a weakening of the stock market, certainly not until the latter part of the week. The market that is trading the best is actually the stocks, and to a certain extent the DAX. It just won't move away from the 200 period moving average, and all the spikes down are very predictable until and unless we get a weekly close below 39.86. I will still start looking for 42, 43 at a minimum in stocks. And that tells me that my view in the SPX is not a million miles wrong. 45.35 will trade many times. Unless we start breaking below 14,760 in stocks, in DAX, still the same thing. I'm still looking for 15,800. And that tells me that these breakdown points in everything are going to be revisited. Breakdown points, we know what the breakdown point in SPX is, 45.35. So really nothing that worries me here. The thing that worries me is actually here in the Nikkei. We are very, very oversold. We did close below 26,910, and we touched the magical 26,195, and really it'll be interesting to see what the Nikkei does over the course of Monday morning our time, because Japan hasn't seen this. To me, it's more likely than not. You can see that all these moving averages up here are bunching up. I would expect another trade up here towards the 28,180, and then it has a chance to really go down. But this and EEM are the only markets which are worrying. EEM is just weak, but on the other hand, I expect it to bounce really hard of 45.04 and go back towards 50. So, it's not all black and white, and that is really what the battle between the 42.35 and 45.35 in SPX is all about. Many cross currents, but the main cross current, which is I'll start again. But the main cross current, which is the bond yields and the leakage of QE out of ECB, and what the European Central Bank is doing, that is the main theme, and that won't be resolved for quite some time. Right, and with that, onto the bias tables. I've updated all the levels. I think the yield curve in the States is now getting to the levels that I predicted. I think that once 210s get towards the 55 support, probably maybe even 50, that should be the end of the flattening of the yield curve. because really it's unreasonable to expect that the twos can really hang around at those very, very elevated levels compared to Fed funds. It's going to be very expensive to be short of twos for protracted periods of time. And therefore, I expect the long end to start wagging the dog rather than the short end. But, we will see. This is going to be interesting. The bubble and the bund, I think if the ECB is dovish, we get to levels where it makes sense to get short of bubble and bund. And I think the risk reward is to just stay short of shats to some extent, in not have 100% allocation, but have a 50-60% allocation, because the day it goes, it just, it'll be like shit off a shovel. It'll be just an incredible move, one which is so fast that unless you're right there to take advantage of it, the only way you can do it is by being positioned beforehand. I've updated all the other levels, and basically I think that 45.35 will be the level that we will trade again and again and again, and come lower and try and bounce off it. That is, to me, the magnet where this market will go to. Right, thank you very much indeed, and tweet you on Monday.